All right, let's talk about investing. Today, we're creating the ultimate playbook for anyone who's just starting out. And it doesn't matter if you're in the UK or the US, we're going to cut through all the confusing jargon and give you a super simple, step-by-step guide so you can start with real confidence. Let's jump right in.
Does this feel familiar? I bet it does. For so many people, the world of investing, with all its charts and its jargon and a million different options, it just feels overwhelming. But I promise you, it really doesn't have to be. In the next few minutes, we're going to slice through all that noise and give you a clear, simple path you can actually follow.
So here's our game plan. It's a four-part journey. First, we'll build a rock-solid foundation. Then, we'll pick out the right tools for the job. After that comes the exciting part, making your first move in the market. And finally, we'll get into the investor's mindset, which is honestly the real secret to long-term success.
Okay, let's dive into part one before you begin. Think of this as getting your financial house in order. You wouldn't build a house on a shaky foundation, right? Same thing here. Getting this part right before you invest a single penny or pound is absolutely critical.
So, these 3 steps, they are completely non-negotiable. First up, your emergency fund. Having 3 to 6 months of living expenses tucked away means that if life throws you a curveball, you won't be forced to sell your investments at the worst possible time. Second, get rid of high-interest debt like credit cards. Paying that off is like getting a guaranteed high return on your money, way better than you can reliably get from the stock market. And third, you need to be in it for the long haul. The market goes up and down, so only invest money you are sure you won't need to touch for at least 5 years.
Now this is the big one. This is your compass. Your why is what decides your how. Are you investing for retirement in 30 years? That's a totally different game than saving for a house deposit in 7. You see, the longer your time horizon, the more you can lean into stocks and their growth potential. So get really clear on where you're headed, and the path to get there becomes so much easier to see.
Okay, foundation is set. Let's move on to part 2, choosing your toolkit. This is where we pick out the essential gear you're going to need for your investment journey, with a look at both the UK and the US.
And these right here, these are the most powerful tools you have. These are special accounts designed to help your money grow faster by protecting it from taxes. In the UK, the Stocks and Shares ISA is just fantastic. All your growth, all your dividends, completely tax-free. Over in the US, a 401k is a game changer, especially if your employer offers a match. I mean, that is literally free money. And at Roth IRA, that gives you incredible tax-free growth and tax-free withdrawals when you retire.
So here is the golden rule, the most important takeaway from this section. You should always try to max out these special tax-advantaged accounts before you even think about putting money into a regular taxable brokerage account. It is one of the easiest and most powerful ways to supercharge your long-term returns.
Okay, next you need a place to actually buy your investments. When you're picking a platform or a broker, you want to focus on just 3 things. Number 1, low fees, because every dollar or pound they take is one that's not working for you. Number 2, a simple, easy-to-use interface. And number 3, access to a good range of stuff to invest in, especially broad market ETFs.
And speaking of ETFs, what should you actually buy? Look, for pretty much every single beginner, the best place to start is a broad market index fund, or an ETF. Why? Because with one single purchase, you get instant diversification. It's like buying a tiny slice of hundreds or even thousands of different companies all at once. It's simple, it's low cost. Individual stocks, they're much higher risk, they take a ton of research, so maybe save that for later, and only with a small amount of fund money you're okay with losing.
All right, this is it. This is the moment we've been building up to. The foundation is poured, we've got our tools, and now it's time for part 3, making your first move. This is where you officially go from being a learner to being an investor.
So, a big question people have is, should I invest a big pile of cash all at once or a little bit over time? For most of us, the answer is something called dollar cost averaging. It just means you invest a fixed amount on a regular schedule, say £300 or $500, every single month. It's way less stressful, it builds an incredible habit, and it means you don't have to worry about trying to perfectly time the market, which, let's be honest, is basically impossible. And the impact is staggering. Investing that $500 a month starting at 25 instead of waiting until 35 could mean a difference of over $250,000 by retirement. That's the power of starting now and just staying consistent.
And you know what? The actual process of buying is surprisingly easy. Once you're in your brokerage account, you just search for the fund you picked out, you type in the amount you want to invest, and you click buy. But the most powerful part? That's step 4. Set up automatic contributions.
Put your plan on autopilot so it happens every single month without you even thinking about it. It's really that simple.
And that's it. You did it. Just take a second and let that sink in. You are officially an investor. You've just put your money to work for your own future. That's a huge, huge step.
So now that you're in the game, we've arrived at our final, and you could argue our most important section, the investor's mindset. Because you can get all the mechanics right, but playing the long game and actually succeeding, well, that's all about psychology.
This chart says it all, really. This is the difference between people who succeed and people who get scared and quit. You have to think in decades, not days. Keep investing on schedule, whether the sun is shining or it's pouring rain. And please, please do not panic and sell when the market drops. Don't check your portfolio every 5 minutes. And definitely don't chase after whatever hot stock your friend is talking about. Discipline is everything. Let's really let this one sink in for a moment. Market drops, corrections, downturns, they aren't a mistake. They are a normal feature of investing. They are going to happen. When you see your account balance go down, it does not mean you did something wrong. It is simply the price of admission you pay for getting the long-term growth the market offers.
And remember, you do not need to be an expert on day one. Your journey is just getting started. As you get more comfortable, you can start exploring other ideas, like finding your own personal risk tolerance or learning the difference between stocks and bonds. It's all just a process of continuous learning.
And we're going to end on this thought because it really is the entire philosophy in one sentence. It's not about being perfect. It's not about being an expert. It's about starting early, staying consistent, and letting the magic of time and compound growth do the heavy lifting for you. The best day to start investing was yesterday, but the second best day, that's today. Thanks for watching.